Good afternoon and welcome everyone to this webinar. I'm Niranjan Avasthi, and today we have with us our MD and CEO Radhika Gupta and our CIO Equities Trideep Bhattacharya. Today we are, having this webinar during very interesting times when markets have been, after a fantastic run for last 3 years, have suddenly turned volatile. And amidst this, we have multiple questions from our partners and investors around whether we should continue our SIPs, whether we should be staying invested in mid cap and small cap, what should we do with investors and investments that have come in over the last 1 year, and many more such questions. So what we have done is today we have divided our session in two parts. The first part, we will have Radhika to share her nuggets and advice amidst this VUCA world and answer many of your questions around markets and behavioral questions that we have. And in the second part, we will have Trideep, who will take up questions on how the market is looking, what has been the reason why markets is going down, and hopefully he'll also give us, when the markets can turn around and all that. So let us start with Radhika. Radhika, welcome to this webinar and thanks for coming and joining us.
Thank you. Thank you. It's wonderful to interact with all the partners. And I think these conversations are important. They're important in all times, but in a good time, your numbers always speak. In bad times these days, media and so many people speak. So I think it's very important for us to have these conversations. So it's good to see you all.
So, Radhika, let's start with the first question. What are your thoughts on current market correction? And, from a behavioral point of view, how should investors look at this and deal with it?
So, because I know Trideep is speaking, I think he will spend time elaborating economic slowdown, earnings, and, many of the factors that underline this market correction. So I won't spend time on that. I'll focus on the second part, which is really how should investors look at this? And I think the challenge that we're having today is twofold. One is, of course, we have many investors who are new investors and first-time investors into the market. We have many investors who are also old investors, but we also live in a slightly frenzied and social media-driven world. Now, I think at this point, all your role as advisors is very important in conveying the right kind of messaging. And I think there are a few points. One is, and Trideep will elaborate on this, while what we are going through is a correction, we are asking customers to invest for 5 years, 7 years, 10 years. In fact, when people talk about mid and small cap, I say, don't even think about it if you're not looking at 7 to 10 years. So we have to keep reinforcing this fact and reinforcing the fact that the structural India story over 7 to 10 years, that thesis has not changed. In fact, India's macros have never looked better. The growth story remains intact. And yes, that growth story is not a straight upward line, so it has its bumps along the way, but we have to keep reinforcing this long-term time horizon. Secondly, I think when this kind of fear mongering happens is one of the fears investors have is what is the worst that can happen to me? And I always believe that if you're an investor who's done a 5, 7, 10-year SIP into any good mutual fund, not very much bad can happen. I shared this data in the context of our own mid-cap fund that the worst 10-year return, and we launched in November 2007, Niranjan, is 10%. The worst SIP return is 8%. These are not bad numbers at minimum. So I think this gives a lot of reassurance. And second is, of course, we pay attention to asset allocation, as I'm sure all of you have been guiding your clients. So in times like this, making sure that investors pay attention to asset allocation, that they really have that dal chawal approach, that they don't forget products that give yield or hybrid products in the portfolio is very important.
Radhika, the other question is around the recent data that, SIP cancellation and on. I'm sure you look at this data on a daily basis. So how does the data look? Is there any reason to panic? How are the flows? Because last month, definitely we saw overall equity flows have been positive. How is this month looking where especially mid caps and small caps have corrected more?
So again, there's been a lot of questions around industry data. Now, if you look at January industry data, industry got 40,000 crores of net equity flows, which is a very, very healthy number. If I look at our own numbers, January was actually better than November, December. So January didn't suggest any reason to panic. February, if you look at the numbers, we are only through half the month. I've seen half month MFTX numbers, I've seen our numbers. Numbers are still net positive. Now, whether they'll be as high as January, nobody knows. As far as SIP cancellation data, I think Amphi published a set of data and there was a number roaming around 100% cancellations. I think you have to understand the origins of the data. I'm sure cancellations are up. When your 1 year SIP return looks less attractive, numbers will not be as good. But there was also some cancellation triggered by the fact there was reconciliation between RTA because SEBI's changed rules on how to classify old SIPs. And I would say this again. I joined the industry in 2017 when the SIP book was 4,000 crores. We are at 26,000 crores. We've seen a broad upward trend. But we've also seen 2018. We all have to believe that SIP is structural. There may be some froth around this 26,000 number, but I think all of us know that 26,000 is not vanishing to 13,000 overnight. And so there's an element, again, like the India story, the MF story has two parts. One part is structural, and I think all of us know that the structural story is not going to change. And one part is slightly cyclical. So if there's 5-10% of froth, it's okay. In fact, a little bit of consolidation, if it is to happen, and I'm not saying it will happen, is actually good for all of us because clients also recognize the value of an MFD or advisor.
Right. So Radhika, what are the three key things which investors and distributors should keep in mind in this kind of market?
So one is, I think, not to stop the SIPs. We've put a lot of data out that when you stop SIPs in times like this, when markets have corrected 20-30%, you really take away from the XIRR. The purpose of SIPs is actually to help you in a downward market. So be proactive and reach out to the investors and making sure that those SIPs aren't getting cancelled. And in fact, there's some other very interesting data that we've put out saying that if you start SIPs in a down market, then actually you recover more quickly. So I think the SIP point is very important. I think as you look towards this year, looking at products that give you yield, whether it's fixed income, hybrid, some of those solutions is something that you may want to consider in your portfolio. Any form of asset allocation, whether it's doing asset allocation by adding fixed income, moving from 70% mid and small cap to more multi-cap, just being in the middle path, being more asset allocative in approach, I think will be important. And the third thing, which is actually the most important thing, is for my MFD friends, this is the time to be visible to clients. It's a time for us to be visible to partners. It's a time for you to be visible to clients. My first big market correction was 2008. And the one thing I did learn from my boss is कि अच्छे market में तो हर आदमी बोलता है. Numbers speak, people speak, banks are there, everyone's selling, there's exuberance. But in a good market, everyone goes away. I think you stand out in your ability to communicate when you are visible in times like this. So your role in hand-holding in preventing panic is extremely important. So if you were 100% visible before, be 150% visible.
Thank you so much, Radhika. I know you have to rush for another meeting, and thank you so much for joining in. We will now have Trideep, answering our questions. And welcome, Trideep. Good to have you. Good day for the market. Good day for the markets today.
The markets are just about catching their breath today.
Yeah, great to hear that. So Trideep, I have first question on the market itself. So what suddenly changed for Indian market? Like just recently, till maybe 6-7 months back, everything was good. India was one of the best performing markets, not only in terms of stock prices, but overall economy as well. Now seeing from there to now seeing a sharp correction, what has changed? What's driving the shift?
So, I think what tends to happen is the reason gradually builds up and then the market recognizes it. So what you saw in the last couple of months Actually, it gradually started sometime in September, if you actually look at it. And if you go, the seeds of it were actually starting from June, July last year. What really happened was that was the time when we started underspending on the economy. So a classic example would be, for example, in fiscal year 25, which is better part of CY 24. And as you know, last year we had national elections. The government budgeted to spend close to 11.5 lakh crores with regards to capital expenditure. And what we might end up spending is probably 20-25% shorter, right? Now, the seeds of this were born somewhere around June, July last year. But by the time it starts percolating down the numbers, it's basically now. So to put this in a more formal format, I would say that if you look at in FY25, we started, projecting a growth of close to about 15% for India Inc., i.e. India as a factory. And by the time we are probably going to end FY25, it's probably going to be a year of no growth, or lost year of growth, less than 5% growth. Now, people come to India for growth. Let's understand this. And when you are sitting on a 10% earnings cut, and as we come to somewhere around Q4 of fiscal year 25, and the market realizes time is running out, there's not that much time to make up for the earnings. That's when you see the reaction that you see. So in essence, to cut the long story short, the markets are just about reacting to the earnings downfall or the earnings correction or the earnings cuts that we have seen since the beginning of fiscal year 25, which have been to the tune of about 10 to 12%. Q3 being the latest one, where we've probably seen an earnings cut of close to about 1 to 2% so far. And as we get to Q4, the final few months of the fiscal year, that's why you are seeing markets reacting to that. So, am I completely kind of surprised or foxed with it? No, we've been talking about this, as I'm sure you know, for a good while, that, this is an earnings-led correction, and hence don't expect a quick respite. But markets tend to respond first gradually and then in one go. That's what you're seeing. So a long-winded answer to your question, but I hope it sets the context of today's conversation.
Right, Trideep. You talked about earnings, and of course, earnings is very important and it plays a vital role in generating returns. In last 5 years, if you see, a large part of returns came through earnings growth as well as not only PE expansion. Now that the earnings have been muted, how do you see how the valuations have changed in this recent correction? Do you see it has corrected meaningfully, or because earnings growth have come down and markets have come down, valuations still are at a higher level? How do you see valuations at this point in time?
So let me bring another angle to this market correction. What tends to happen is when you have 2 or 3 years of positive returns, all types of stocks go up. Some stocks which are great companies, and by virtue of earnings, some which are simply the beta trades, which I call it, or the narrative trades, which are companies which are in the right place at the right time in the right sector, but fundamentally the businesses are not great. So all of these tend to go up in a jiffy when markets are strong. In phases like these, what you see right now is market differentiating between what's beta and what's alpha. The beta part with the narrative stocks, or so to speak, the companies which have inherently weakness in their business models, but they went up because they were in the right sectors. They were in the sectors that people wanted to invest in. They are finally hitting the ground, saying that, hey, earnings have not been that strong. But when such a trade happens, what also tends to happen is companies which have sound earnings also tend to come down. And that's the opportunity for us as active managers to pick those in this correction, because markets in times of correction treats everyone well, or in the same boat, to pick the ones which are fundamentally sound business models with strong earnings trajectory, strong moat, but have fallen with the rest, and leave the ones which are more like beta trades. So in a nutshell, the markets are differentiating between beta and alpha. This usual sort of cleansing, if you may call it that way, happens once in 3-4 years in markets all the time. And if it continues so far long, then we have a crash. We haven't had a crash, we've had a gentle correction. And it's good that the market goes through that because it cleanses itself and then rises for the second round. You talked about the valuations. If you look at valuations today, and I'm sure you can't look at valuations in one go. You have to look at valuations of large caps and then mid and small caps separately. I would say that in all of this, large caps have corrected to a levels which is probably attractive, actually less than 10-year average. Mid and small caps, there is still about 15 to 20% premium remaining versus the 10-year average. So hopefully that explains the correction, the part of the correction which is kind of happening in the markets and how the valuations have stacked up.
So when we talk about valuation, you highlighted that mid cap and small caps have been at a premium, and they've been in the premium zone for a long time. But one of the data which we all, I'm sure, would have seen that in last 3-4 years, mid cap, small cap earnings growth as a percentage in for the segment has also been faster than large cap. Are you seeing any turnaround in that? That are they now being muted at a category level? While you said, between the category, there will be some stocks will be growing faster. There'll be some stocks which had froth and will be growing maybe slower. But do you think mid cap and small cap earnings growth, which were at a faster pace than large caps, will now come down a bit?
I think this is a tougher question to answer than you think. And the reason I say so is, so first of all, your observation is right. That if you look at last 3-4 years, earnings growth of mid and small caps have actually been kind of double that of the large caps, right? Mm-hmm. In an expanding economic recovery, that usually tends to happen. So by corollary, when we analyze, slice and dice the market's correction or the earnings correction that I talked about of 10% so far, what we find is the similar sort of observation is not correct, i.e., it is not that the large caps have had the smallest corrections and the small caps have had the largest corrections. In fact, I would argue actually, once we look at the data, large and small have the highest corrections. Mid caps are the ones which have least amount of correction. Now we are doing this analysis at a point in time. Maybe over a period of time things change, but as of now, that's the picture. So just by market cap, you couldn't conclude that the small caps would have had the largest correction. In fact, large caps would have had equal corrections because earnings correction, I mean, not stock price correction.
Yeah.
Because in some parts, the large caps are losing market share to the mid and small caps business-wise overall. So I think this lens of large, mid and small caps, number one, will undergo a change as we as investors and distributors and all of us think about investing. Because when we think about investing, we don't think about large cap, mid cap or small cap. We analyze a business. The largest AMC, listed AMC in India is basically a mid cap. The largest genset generator is a mid cap. So they are industry leaders, but still the cap categorization doesn't really materialize in that context. So so I would say the answer lies in the pockets. Some pockets of mid and small caps have reached levels where they are worth looking at, and some within large caps. So the best approach in such circumstances is what I would call a typical khichdi approach, which is not get constrained by market cap, but look through the market caps with the lens of the good businesses where stocks have corrected, earnings downgrades have been limited, but valuations are more reasonable than what they were probably a year ago. So that's the framework we are using to kind of to hunt for stocks in the current market.
Right. So, well, probably, from your commentary, I can guess that we are heading towards a market where it'll be more to do with stock picking and stock specific ideas that you have in your portfolio and funds rather than market segment. Because in last 3 years, it was quite easy for everyone to spot, okay, let me invest in mid cap and I'll make double the return of large cap. But I think so we are getting into a world where probably a flexi cap or a multi cap approach would be much better.
This is a very smart observation. And if you don't mind, I might want to add one point on this. And this is exactly what the market is separating right now. The easy parts of the trade, which is what I called as the beta trades, are out of the way now. Now, the market is bringing out those parts of the trade where there is genuine reason for the stocks to go up, which is that earnings have gone up, or that segment is kind of getting far bigger. The sector, the tailwind is far bigger than what it was before, and things like that. Just because, for example, PSUs, just because you've been a PSU doesn't mean that, all of a sudden things will go up, which is a lot what happened last year. So themes, trends, which have been kind of, the usual way to talk through in the last few years, will lead its way to genuine, hard-nosed, tough stock picking over the next couple of years. We've got a job to do.
Right. And for that, I think so fund managers need flexibility. And I think so that is where we can bring in our second agenda of today's call, which is a Flexi Cap Fund, which has completed, Edelweiss Flexi Cap has completed 10 glorious year. And the performance under your leadership and the erstwhile fund managers over the last 10 years have been very, very good. I just wanted to highlight some numbers, and I'll just take a moment to share some numbers on performance. So if you see over the last 10 years, that is since inception, the fund has been able to generate a good 1.5 to 2% kind of alpha. For the last 3 years specifically, and 1 year, the fund has generated even much better alpha. In fact, last 1 year have been extremely good. My question is, Trideep, in this kind of market, and of course, over the last 10 years, how this, fund has been done, what has been the philosophy while running this fund? Because it offers a lot of flexibility to fund manager to actually spot good stocks rather than good segments of market as a whole. So how do we run this fund? What has been the philosophy which has helped generating this alpha?
So I think two bits that I would point out. First of all, over any meaningfully long period of time, for one to outperform, it is not just individual brilliance. It's always reliance on a robust, meaningful process being followed with discipline. And this is where it's not just me, but the entire team following the framework on a day-on-day basis, even when markets are down 2%, to retaining the sensible hand even when markets are up 2% on a day, and to kind of diligently go through the process. And very quickly, I would take you through the 4 elements of the process because it's very important. So we call it FAIR, which is forensics, acceptable price, investment style, agnostic, and robustness. So essentially, what we are talking about is we are bottom-up stock pickers. We're interested in financially clean companies. We are interested in robust business models that can not only grow but have return ratios more than cost of capital. In the way that we go about investing, we are quite investment style agnostic. And finally, whenever we buy a stock, our starting upside is 20% or more. Now, if you ask me of these 4 principles, the 2 principles which have really helped us over a period of time are, all the 4, but of the 4, if I had to highlight 2, one is the forensics, particularly in tough markets, and the second is investment style agnostic, particularly in the markets which changes style in a good while, particularly in the last year or so. The forensics bit usually keeps us away from the negative alpha, or basically, where promoters' interest is not aligned with minority shareholders' interest, or we find based on our analysis that the company has not dealt with the shareholders as cleanly as one would expect it to be. And there are many examples, but net, it keeps us away from the bad apples. We try as much as we do, and we are very diligent about kind of, very humbly looking for, even during our holdings and picking stocks, that we don't get into some of these bad apples in the first place. And secondly, smell them at the earliest if we have got into one. The second bit, which I talked about, this investment style agnostic, is also an important point to highlight. We think that this value, growth, momentum, low vol, all of these are individual ways to categorize different styles. And at the base of all of this is plain, simple stock picking, which is we rely on intrinsic value of the company and where the share price is trading and the difference between the two. And we get to intrinsic value kind of looking at the cash flows of the company. and no sort of noise around whether it falls into a particular index or a particular style. What that does is we become style indifferent, and in that case we stay relevant with regards to kind of at all points in time, particularly in the times that you have highlighted. And that's the reason why through the times where different cycles have come through, we have been able to kind of deliver numbers. And I would be probably the first, but very humbly admit that while you see skill, there is an element of luck which is also involved in this performance. But over a period of time, and a long period of time, which is 10 years, usually the luck evens out and the skill stands to stand out. That's what you see in these numbers. And we keep, while we would love to do good performance all in, what we hang our hat on is the process and the diligence with which we go about doing that. And hopefully the number follows going forward as well. Thank you.
Very well put, Trideep. Over the long run, actually process trumps luck, and the role of luck actually shrinks down. So over the last 10 years, I understand it'll be quite difficult to tell us how the portfolio has moved, but specifically last 3 years where we have seen a good alpha generation, and you have been running this fund very closely during that period. What have been the key changes? Because in last 3 years, and you rightly interestingly pointed out that the philosophy that we follow in this fund is investment style agnostic. In last 3 years, there have been phases where value have done well, then quality. So I wanted to know how the portfolio has also shifted in terms of themes and sectors, which has helped specifically in last 3 years during the
Sure.
10 years.
And I'll put rather numbers in a story format because that will help appreciate you and the listeners better. 3 years ago, we were really coming out of COVID. It was so obviously the business cycle was negative or was contractionary, and from there, so it was an early stage of the business cycle. And at that point in time, our portfolio was more value oriented. And even though in the way we went about doing this at that time, the way we kind of analyzed this is at that time, those stocks had maximum amount of upside. But over a period of time, what we found is that the valuation gaps or the valuation spreads actually narrowed. And as valuation spreads narrowed, value and growth became indifferent. So our style oriented a little bit more towards growth. And as I described at the beginning of this conversation, that over the last year or so, we had an earnings cut phase, which is contractionary phase from a standpoint. We went a little more defensive. So in this way, as you can see in the story format, that we've had three styles really: value, growth, and then defensive. And for navigating through different style periods with an even keel, what we did was to kind of anchor ourselves around which types of companies would continue to have earnings upgrades in absolute terms or in relative terms versus the broader market, and to be present in those hopefully ahead of time so that we can kind of generate alpha. So far, we have been able to do that. And in this process remain style indifferent because we were focusing on earnings upgrades and cash flows. And we hope to do that going forward as well.
So last question on FlexiCap, Edelweiss Flexi Cap Fund. Trideep, how is the portfolio currently positioned? Because things are changing a lot in terms of sectors, in terms of market cap. How are you positioning this portfolio right now?
Right. I think the first thing that I would honestly admit is we never played the market cap game in the context of this fund. Our market caps is very similar to how the benchmark is, and we make no bones about it. We say that it will be this is a fund which is actually very relevant for a conservative investor with a slightly higher bias towards large caps, and it will continue to remain biased towards large cap. The large cap percentage, which is currently roughly about 70%, give or take a couple of percentage points, is probably on the higher side because we find valuations favorable there, and over time maybe it goes a little lower, but it will continue to be large cap heavy. And hence, as in terms of appeal, this probably appeals more to a conservative investor who comes from either large cap or balanced advantage or more conservative categories than a more aggressive investor. That's one point that I would like to highlight. In that context, I would say that, as I was saying, that over the last year, there was an earnings contractionary phase. And what we did was kind of, turned a little more defensive. So around about a year or so ago, we went overweight IT services. We remained IT services for a good while, for a better part of last year. That certainly helped. We continue to remain the same. Second, basically, we called out, consumption to be the dark horse of calendar year 25. That's an area where, if you ask me, we probably will be neutral at this point in time, but it's an area where we've increased our weight and hopefully our weightage in the portfolio. And hopefully over a period of time, as the tax breaks were to sort of come into force, we would probably kind of, at the right valuations, look to get overweight in this space. So that will be two sectors. Third, we are positive on NBFCs. We think that, as rate cuts stand to happen over a period of time, this segment of financials, which actually tend to do well because of better earnings. And this is one segment where we have very good valuation support as well. So that's the third area that we are positive on. We haven't given up on manufacturing. That's the fourth area. But the reason I say fourth is because it used to be one of the highest weights in our portfolios. It has now come down materially versus where it was earlier. In sync with times, in sync with the government's focus on the balance between manufacturing and consumption. But that's another area where we think that it will continue to do well over the next 3 to 4 years. Maybe the pace of growth will not be as strong as what we have been dealing with in the past. So that's the fourth sector that we are positive on. And the fifth one would be real estate. If you ask me, real estate is a more mature theme of all of these that I talked about. It's broadly played out with the builders kind of doing well. Now, the ancillary sectors is something that we are probably placing more interest on. We think they have more to go. The objective behind Niranjan mentioning these 5 sectors are that while, of course, these sectors have stocks, and ultimately it's the stocks that we're interested in, but we find that the stocks in these sectors have something more than other sectors to go with, which could be an industry tailwind or a regulatory tailwind or a company-specific tailwind that will kind of, keep the earnings relatively stronger than that of the broader market. So that's the thinking. And with these, we think that over the next 2 to 3 years, on a bottom-up basis, we will continue to do well or better, like we have been doing in the past. Of course, there is no guarantee. We try our best, and hopefully the best follows.
Thanks, Trideep. Coming back to our discussion to markets, because we just have never-ending questions around markets and a lot of questions pouring in. I, request viewers, if you have any questions, do post them, and we'll try to answer all of them. So coming back to markets, Trideep, we've had a budget which has largely changed its color in terms of the focus. Does that, or will that change something in the market in terms of sector rotation and all? Because when I look at your 5 themes also, it is a fair mix of, investment side of the economy as well as consumption side of the economy. So how did you see the budget, and what impact it will have in terms of sector rotation and overall things?
Indeed. So I will give you the answer, which is probably what you want to hear, and then confuse you a little bit. So the answer was very clear in Modi 2.0. It was all about capex, capex, and capex, and to hell with the rest of the area. And mirroring that, we've been massively overweight capex theme, and we've done well out of it. But after the last elections, where not only government, but what we found is that the outlook towards different sectors changed a bit. It is and if you look at the budget, it's a far more potent mix between investment and consumption. So just to put numbers here, if I look at FY26, which is the budget that got just presented, we are talking about a capex growth of 10%. But at the same time, we gave a tax SOP, which tantamounts to, for middle class income people, roughly about 2 to 7% increase in their salaries on a per annum basis. Now, on average, salary increase in India is around about the same, overall. So practically, the Honorable Finance Minister has given another salary hike on top of to a normal consumer. That's meaningful. How much they spend remains to be seen. But a meaningful boost to consumption this time, and capex has been let grow at the same pace as it has been in the past. So it's a lot more balance between investment and consumption, and that kind of mirrors how our portfolio is struck at this point in time as well. The moot point, Niranjan, in all of this is, while these are all good intentions, the question is how much the data really follows. In the sense, does the consumption really kind of pick up on the back of this? We will only know in a couple of quarters. And that is when I think overall we will actually see where markets start to make a comeback. If you recall, the first thing that I started with was a 10% earnings correction. The second corollary of this is what will make markets rebound. So as we get towards FY26, two things will happen. One is that post-April, as the tax SOP starts hitting the consumer in the positive way, sometime during probably festive season, you would see some fillip onto the consumer spending overall. That's one. Second, one of the issues that we had last year, which is calendar year 24, was that we spent meaningfully lower than what we budgeted for in CapEx. So government CapEx was missing. Government CapEx will also start to come back. So as a combination of these two, as we head towards second half of fiscal year 26, we think that a good amount of rebound could be expected with regards to earnings. And that's the path I would plot for markets to also come back. So it's not going to come back in a jiffy, but will follow the earnings overall. Well, that's what my thinking is. Markets generally preempt these things. And hence, I would say earnings coming towards the back half of 26 would be probably a harbinger for markets to do better as well.
Trideep, the another big question is in the minds of investor is things that are happening in US. So how linked or insulated Indian markets are to that? Because is this one of the triggers for FIs moving out of India, along with the other points like earnings and all?
I think it's a great spot that you make and worth understanding what's happening there. So, beginning of the year, there were really three imponderables. One, we have got clarity on, a meaningful amount of clarity on, which is the government spending. We now know how much the government is going to spend on CapEx, how much they're going to spend on consumption. So that part is out of the way. Now all of us can make our own forecasts and judgments on the same. The second is the global part, which is Trump, United States president taking over as United States president, and the tariffs and the barriers and all the fun of it flowing through for the rest of the world. Now, these parameters is something that is gradually unfolding. It's an unknowable, as I say openly. It's very difficult to kind of preempt this. Better to see this through. But I would say that by 1st of April or the first week of April, we would know all the policies of Trump as well. That's the second big unknowable, which will continue to haunt markets till then. Once that is out of the way, then we start to kind of gradually stabilize the earnings and hopefully start to come back, which is why I placed a pointer around second half of fiscal year 26 coming back. So from here on till about April, May, it's the global factors which will kind of, drive the gyrations in the market. And in the context, some positive, some negative. You touched upon FIIs. Now, quite frankly, when Trump talks about making America great again, with the policies tailor-made towards reviving US corporate spending, along with tax breaks, which are not yet come, but at some point will, maybe. What that means is we are dealing with a stronger dollar environment. And in a stronger dollar environment, FIIs who are benchmarked to dollar, obviously their returns get eaten away when they invest in emerging markets. That's the first and foremost reason why they have withdrawn money from emerging markets for about a year or so. And that lies the answer that as we see dollar stability, as we see kind of, dollar finding its own equilibrium level, that's when we would see probably FIIs actually stabilize. Are we there? In the way these things operate, you tend to have an overshoot and then gradually find an equilibrium level. So I am better to point out a time frame. I think by the time we hit March, April, let's call it, dollar would probably find its stability. And that's when I would say that FIIs would start to look at, India back again in the true context that whether you like it or not, times well with ensuing earnings recovery also. So all in good time, Niranjan. But nothing is happening in a jiffy if you were wanting to hear good news overall.
I think so. I mean, somewhere you were talking in some other session, and you rightly mentioned that this year is to invest, and following years will be years to harvest that. So I think so. It goes well with really long-term investors, and after couple of good years, I think so. This is a year where a lot of our investors and distributors would get opportunity to accumulate those units and then stay put for next 3-4 years. So I would say it's a good break from the things that were going up. I think so. We have covered a lot of ground, Trideep. One last question before we let you go and end this webinar is, your advice for investors, both those who are already invested and those who are considering entering this market now.
So the advice has got to be the same, and I would the issue of giving an advice more generally is ultimately kind of the investor is very specific, his needs are very specific. So the first thing is speak to your advisor with regards to the risk appetite and invest based on that. But if I were to sort of draw a canvas in front of you in terms of some broad thumb rule that might help investing during these times, I would say that first of all, I am a big believer of markets being a slave of earnings. And hence, as I said, in my best understanding, I think markets will come back in the back half of fiscal year 26. Markets might be a little bit ahead of time. It's best way to enter markets in a staggered way rather than in lump sum at this point in time. And maybe over a 6 months time frame is the best way to kind of invest or take advantage of the weakness in the markets. That's number one. Second, what type of funds are particularly suitable in this market? So generally, as I talked about this khichdi approach, fund managers need at the moment the flexibility between large, mid, and small to invest. Because the dynamics are changing fairly kind of rapidly, and hence I would say that a mix of these is the way to go about investing. What I mean is, for conservative investor, a large cap heavy flexi cap fund might be just about what the doctor ordered, because it's conservative on one side, but at the same time, when markets recover, it has some element of mid and small caps which will participate in the rally as well. For investors who are more balanced in risk appetite, or the confused investor, I would say a multi-cap fund would be just about right for the course. Just about 50-50 broadly between large and mid and small. And as the markets recover, they participate. On the other hand, when it falls, it's just about stable. But for investors who are kind of looking towards the beyond the correction, the long-term steady of 5 to 10 years, I would still say that a mid-cap fund is just about the right course, as long as you invest in a more staggered manner. So broadly between these three categories, one could find its own, soulmate, as we call it, as we just came across the outside of the Valentine's Day, and find the fund that suits your risk appetite, the return goals, and the time horizons, and invest accordingly. And finally, I would say that starting my career in 99, 2000, just when the tech blew off, I have seen multiple sort of such blow-offs and multiple rounds of bullishness. I think staying the course, staying invested is generally the right way to kind of ride through all of this, these times. So after all the advice with regards to how to invest, which funds to invest, the most important part is basically stay invested and stay for the long term rather than trying to time the markets overall. So the final advice would be time in the markets is far better than timing the markets. Niranjan, that's the best I can do.
Thanks, Trideep. Thanks for spending time and sharing your experience and giving that confidence, and also sharing how the portfolios are positioned. How do you think about the market? A lot of takeaways for our investors and distributors. We will end this webinar on this note. Thank you so much for participating. We'll keep in touch. We will have more communication. We will have more webinars to handhold our investors and advisors. Do get in touch with our relationship managers. If you need any help, do reach out to us on social media. And thanks, Trideep. Thank you so much. Have a great day.
Thank you. Thanks, Niranjan, and happy investing.